So just so you know how this will run, so in shortly we'll kick off and we'll go through to 11:30 with a discussion on all mortgage industry headlines taken from our industry publications. At 11:30 we have Laura Smith, our sales and marketing manager here at Knowledge Bank, and she'll do a 5-minute overview of the criteria updates and changes that we saw in the market last week. And then at 11:35 up to 12 o'clock, when we stop, we invite people on stage to comment and ask questions. So if you want to do that, I'll remind you later on in the session, and you can raise your hand and I'll bring you up onto the stage. To keep things flowing, we say questions and comments should be kept to around 1 to 2 minutes and be as precise and succinct as you can. Now, we have a fabulous panel of industry speakers today, so let me introduce them. First of all, my name is Nicola Firth. I'm the CEO and founder of Knowledge Bank, and I'm joined, as always, by the fabulous Laura Smith, our sales and marketing manager. And today, we also have Graham Wilson, the partner from Options Mortgage Network, Malcolm Davidson, managing director of UK Moneyman, Claire Askham, head of mortgage sales for Buckinghamshire Building Society, Tom Denman-Malloy, the intermediary sales manager for Mansfield Building Society, and Andrew Sadler, the key account manager for Suffolk Building Society. So good morning, everyone. Now, we're going to kick off this morning. What can we say? That there's really one topic of conversation, isn't there, in the industry? And of course, that is what happened last week, and lenders and brokers alike still feeling it. So let's kick off. The total residential mortgage count, so we're just residential, not even buy to let at this stage, had fallen by 935 mortgage products overnight from Tuesday the 27th of September into Wednesday the 28th, bringing the total number to 2,661. Now, according to the figures, which are from Moneyfacts, this was more than the previous record fall of 462 on the 1st of April 2020, which was at the start of the UK's lockdowns due to the pandemic. Figures showed that the largest falls were in 2 and 5 year fixed rates, both contracting by 344 and 357 respectively. Now, lenders have been temporarily pulling products to reprice them due to the fall in pound, soaring swap rates and base rate increases. But I want to know the thoughts of our panel about the current situation from both a broker and a lender's perspective. So lots to say on this. Who would like to go first? I don't mind brokers or lenders. I'm coming to you all. Claire, how were things last week for Buckinghamshire Building Society?
Yeah, as you can imagine, Nicola, it was a little bit crazy last week, as it was for lenders and brokers. We got quite a number of plans that we was hoping to go forward with this week, but obviously we've had to do a bit of a halt to just give the market time to settle and obviously see, where we can look to move forward. Lenders, as we've seen, obviously are pulling rates, are giving as much notice as possible, but that sometimes can be really tricky in the current climate. But obviously we want to work with our brokers where possible to be able to do that. But it's hard to sort of see which way this is going to go and how it's going to sort of settle down and start to ease. I think, for the rest of this year, it's going to be quite challenging. And I know I was at one of the events last week and, that the hot topic, brokers had took time out of their day to come along and speak to lenders just to try and understand, what lenders' thoughts are for the remaining months that are left this year. And, are lenders still lending? And if so, what products do they have available? And what are you going to be doing for the next few months? So that was certainly the hot topic last week, following on all the announcements and all the changes that was happening. It's just very tricky at the moment to try and, balance out, where we want to lend, what we want to lend, but also we want to make sure that we can support the broker market as much as possible. So it's challenging at the moment.
Yeah, absolutely. And it says it all, the fact that brokers took time out of their day to see you, doesn't it? I mean, that speaks volumes. Tom, I'm going to come to you next from another lender's perspective, and then Graham from Option from a broker's perspective. So, Tom.
Yeah, I echo what Claire said. Really, it's really tricky for brokers and lenders alike. And I think what makes it more difficult is not only the change, but the pace at which things are changing. So if you think about swap rates, for example, they've just rocketed up over the past couple of months so quickly, and the market's so volatile that it makes it really, really difficult for well, for lenders to keep on top of everything, and then for them brokers to be advising their clients. But what I think probably doesn't help is that we did see a lot of the sort of the press going out to say that lenders withdrawing products, and whilst that's true, I think a lot of the cases it was actually repricing rather than sort of withdrawing from lending areas. We like a lot of lenders of our ilk. We're subject to swap rate costs and what changes that makes. So it might well be that we pull product, but invariably it's we're looking to reprice rather than pull out the market altogether. But I think there's quite a lot of doom and gloom, which then passes on to consumers who who do worry and pick the phone up to their broker really. So I think it's quite a difficult time for everyone at the moment.
It's a really good point, and I think that a lot of the press last week. I'm not talking about our industry press. Actually, I think if you watch the news, the BBC News, Sky News, and all of that, the temptation to sensationalise and how that's impacting what brokers are seeing. Graham, I'm going to come to you next, and then Malcolm, you've also got your hand up. I know we normally have one or two people commenting, but it's just such a big subject. We could go all session on this. Graham, what was it like for you last week?
Yeah, it wasn't great, to be fair. It was definitely a challenge, and not just from our perspective to keep staffing for, but also the fact that you've got to keep a hat on. People actually texting, your customers are actually texting to say, please tell me, Graham, that this is all right. It looks like London's burning, and effectively, I think that's the kind of feel that you got. It felt like coronavirus all over again, didn't it? Getting multiple messages from lenders to say, products are being pulled, and the customer doesn't know what the difference is between a product being pulled to actually monetarily, lenders pulling money from the market. They can't differentiate, and that's a key aspect of it all, isn't it? And it's our job to tell clients that really it's the product. But yeah, that it was all up in the air, Nicola, for sure. Stressful.
It's a really, really good point. Differentiating the two. Malcolm, how are things for you?
Well, this morning's all over the place, really, because we're still waiting for lenders to come back, and the sourcing systems must have a hell of a job on at the moment because the changes are coming thick and fast. And from a broker's point of view, you're looking at your sourcing list, and you feel like you're just looking at mirages. You think like you're looking at products that were there some days ago, as the sourcing systems obviously find it difficult to keep on top of what's happening. Picking up on Graham's point there, I think brokers did a great job last week. We obviously, a lot of us were invited onto mainstream media to try and keep things calm. I was one of those people on the BBC, and I didn't watch it back because we were so busy for a couple of days. But when I did watch it back, I noticed that the interviewer mentioned certain quite emotive words like panic, anxiety, and worried. And I think we have to understand that these words do feed into consumers, and that's is creating that chaos, which we really don't need. So I just want to have a bit of a shout out for everyone that played the part last week and trying to keep a lid on things as the chaos kind of unwound.
Thanks, Malcolm. And a flurry of emojis there, hearts and claps, agreeing with you on that one wholeheartedly. Yeah. I'm going to stay on with something you said there, because actually we made the headlines last week at Knowledge Bank with our response to the rapidly changing market conditions. So with some of the product sourcing systems putting out statements that they were struggling to keep up and were days behind, the team here at Knowledge Bank were keeping brokers up to date with live banners on the system detailing the current status of product pulls and relaunches, as well as sending out daily summary emails to brokers to help them keep them informed. Now, the team here thought that was vitally important, as brokers could potentially be wasting time sourcing and recommending products that weren't available, and arguably were still doing decisions in principle for clients, leaving a footprint on their credit file when the lender wasn't going to be able to offer them an option because of product pulls. Now, we've done this and it's been gratefully received by both brokers and lenders alike. But my question to the panel is, should there be a better way? How is updating product sourcing systems such a manual process in 2022? And should we not have more robust procedures in place for times like this, which has happened before, and let's be honest, are likely to happen again in the future? Keen to hear from lenders and brokers, but lenders, I mean, you guys, you're the ones that are updating these systems. Andrew, I'm going to come to you first and then to Claire.
Thank you. I think it is difficult. I think you have to combine the updating of the sourcing systems and the criteria systems, and updating brokers directly by email. I think that is the best way. You then have also your website and make sure that's updated. The challenge is obviously then, do we get to a position where the brokers have to check the lender's website? They see it on the sourcing system. Do they then check the website as well to make sure the products are still live? And that's labour intensive, and that isn't easy. And I think it can only be, you can only get it out there as quickly as you can, unless you've got sort of direct links from your product changes into, through APIs and things into sourcing systems. Realistically, it has, it just is still a manual process. And I think, there's been such positivity and impressive attitudes from the brokers. Malcolm touched upon it there as well, in looking at just all those options out there and staying positive and being communicative with their customers. And I think that communication is the key. We as lenders have to keep communicating.
Yeah, such a good point. Thanks, Andrew. Claire.
Yeah, I mean, there isn't really much more that I can say on that, Nicola. Andrew's just said it all, really, and said it very well. I mean, for us, and other lenders will be the same, it's, realising that, we are going to have to move quicker than what we've ever done in this market before. So making sure that, we've got the correct infrastructure to be able to process those changes really quickly, to make sure we can get the communication out as quickly as we can to brokers, making sure that we can get the website updated. I mean, there are challenges with the sourcing systems, and I sort of agree, in this day and age, you'd think there would be a better way to do it, but unfortunately there isn't. So it's very manual at the sourcing systems end. And, we're in the process of changing products now that are due to go today, but they probably won't show on the sourcing systems for a couple of days. So it's just trying to be as agile as we can at our side, try and provide the information as quick as we can to the sourcing systems to give them a bit of a head start, but just making sure that we are communicating with our brokers, because at the end of the day, the brokers are out there, they're speaking to the customers, they've got a very difficult job at this moment in time to try and, find the right case, the right product for their customer. So we just need to make sure that we can communicate as best as we can. And I think by the industry working together, what you guys have done at Knowledge Bank has been super helpful. I know you led the way in COVID, doing the updates as well. So I think everybody sort of pulling together and working together, hopefully we can get those messages out as quick as possible, really.
Absolutely. And that's, as an industry, that's what we're good at, isn't it? We're coming together when the chips are down to make sure that everybody is looked after. Graham, you had your hand up there. What was your thought on that?
Yeah, from a broker's perspective, you're right. It's too much of a manual process, actually. To have a system in place that could connect to the sourcing systems would be amazing. One central place that they could update that would then API to the alternative providers would be excellent and would help to cut down. But one thing that doesn't really help is when lenders put a 5 p.m. Dead stop on products. And I understand that they have to pull them at some point and they have to draw a line. But what gets me is they're doing that in work time as well. So we're all seeing clients still at 5 o'clock, 6 o'clock, as well as that. If they were to put a later extension on, bear in mind that it's such a volatile market, that to me would seem so much a sensible option and fairer to the broker, actually, who are still seeing clients in the daytime. So short term, we're pulling these rates really doesn't help. And it puts even more panic, obviously, back on the clients.
That's a good point. And with my old broker hat on, I've been in that position. Do any of our lenders want to come back on that? Would it really make a difference if you said gave a broker until 10 p.m. that night to get business in rather than taking it at 5? Tom, how about at Mansfield? How would you view that?
Might be stepping into the firing line here a little bit, but I'll just tell you for a little bit from a lender's perspective. Part of the reason that we do it, and as I'm sure the guys will be aware, is that the fact that swap rates move so quickly. So think about us, for example, we swap out on completion. So we're not necessarily looking at today's swap rates. It might well be 3 months in time. So what that means is potentially products we're selling today or a couple of months ago might actually put us underwater in terms of profit. What I would say, though, is that, we want to make sure we're working with the broker community. So, the intermediary lending is absolutely the heart of what we do. So what we do at the Mansfield, and I do completely agree, Graham. I saw a few horror stories on LinkedIn. Sort of midday, you're going to pull a product, and then by 5 o'clock, and system's down during that meantime. So it's really difficult and doesn't help you at all. So what we do where possible is we'll call every dip that's been. If we're going to pull a product, say if we pulled it today, for example, we'll try and make sure we call every broker who submitted a dip on that product within the last month. To give them a heads up that it needs to be in by end of the week, or say probably if it's today, say Wednesday, for example, to at least give brokers a couple of days, to at least get that application in. So we do, where possible, give as much time where we can. I can't obviously speak for other lenders, but that's certainly what we've always tried to do, because we want to make sure that we're not one of those guys that are pulling it within 30 nanoseconds worth of notice. So we do, where possible, give as much notice as we can.
And I'm sure that is appreciated. And just to say as well, lots of people, lots of lenders, lots of brokers in the audience. When we get to just 25 to 12, I'm going to open the floodgates and let everybody come up on stage and have their say on that. So if you're sat there chewing on your own lip thinking I've got something to say about that, then 11:35 is your time. Just raise your hand and I'll bring you up and you can have your say on it. So just staying on this very similar theme, I'm really keen to hear Graham and Malcolm's thoughts on this. So we've seen many reports in the news last week of brokers being contacted by their clients who are keen to pay big early repayment charges in order to fix their rates in an attempt to counter rising rate rises, increasing rates, following the pound hitting record lows and financial markets reacting badly to Chancellor Kwasi Kwarteng's mini budget from the prior week. Now, the news has been dominated. The Bank of England's Monetary Policy Committee will look to increase the base rate even further, fueling customers thinking, perhaps in many cases, as you alluded to, Malcolm, without fully understanding this and how it affects or maybe doesn't affect the mortgage rates. So I'm really keen to hear from you on what sort of requests you had. I did see one. We've got Mike Aldridge, who's on the panel next week. I did see that he had a request from a broker with a £40,000 early redemption charge, which is just eye-watering, but that just shows how desperate people are to come out what they're on and say, can I fix? Malcolm, I'm going to come to you first and then to Graham on this one. What have you seen last week?
Lots of that, Nicola. So we've had people considering paying early repayment charges of 6,000, 8,000 to come off a rate of 1.15, 1.25%, something that they would never normally consider. And of course, it's linked back to the first question, the calling us up off the back of the sensationalism from the mainstream press last week. But it's probably best illustrated by a real case example. Client reached out to us during the height of this noise in the middle of last week, and she said, "Look, I'm one click away from doing this product transfer with my existing lender, but before I do that, I was wondering what other options are out there." And I said, "Look, you've spoken to me now. Let's just invest this 5 or 10 minutes and have a look at it." Turned out this lady had borrowed an extra £15,000 for some IVF treatment, which she'd put on a second charge mortgage, a much higher rate of interest. And I said, and she was very worried that if interest rates went to 6%, that she wouldn't be able to afford a mortgage. So little chat, and I said to her, "Look, based on what you said, if you were looking to consolidate that other mortgage into your first charge, I could save you £150 a month, which is significant with this client's budget." And she said, "I'm so pleased that I've rang you. Sounds like a great idea. I'll speak to my husband." And we re-engaged. We booked another appointment. Well, I got a text off that customer only 3 or 4 hours later. Said, "I've panicked. I've done the product transfer." So that's potentially a poor consumer outcome off the back of them reacting to all the stuff that we're hearing in the press.
Yeah, absolutely. And you've done all you can in that situation and given the best possible advice, isn't it? But as you say, just reacting to what's in the wider, as I say, not our trade press, because we all understand, but the bigger press, the BBCs, Sky News, ITNs, and all of that. Graham, how about options? What have you seen there?
Yeah, well, very similar again. People panicking, thinking that it's going to skyrocket, and obviously they want to secure the rates. But interestingly enough, I've actually gone back to basics with our clients, and we've actually booked mini budget planner sessions with them. So we can actually say, look, you might be paying this much at the moment. If you were to remortgage now, this is how much it would be, and this would be an increase of. And yeah, you see an increase of anything from 50 quid a month to maybe £200 a month. But I think it's that reassurity. It's the not knowing that's scary, isn't it? So if they don't know, then it's frightening. They think it could go as much as £400 to £500 a month. It's down to us as brokers to make it realistic and make it real for them. And it's not necessarily them having to change now and pay the penalty. It's them just knowing. So I think that's the knowing that's got to be key for us across the industry. And also the fact that they might have to cut the cloth accordingly. And they've said that, and they can plan for it then as well, ready for when that, obviously that fantastic rate ends. They were never going to be here forever, but of course, it's come that time now. We've got a bit of a shock, and it's just that shock that they need to overcome. And it might be one less restaurant outing, cut a little bit down on your TV subscriptions, and obviously restructure your life around the fact that rates have increased. So yeah, budget plan is key for us, Nicola.
Absolutely, what a great initiative. Thanks, Graham. I want to talk now about landlords. We saw last week Mortgage Solutions reported that brokers are recommending that landlord clients hold fire until fixed buy-to-let products return to the market, as deals have quickly disappeared from the market and then been repriced. And according to Money Facts, the average 2-year buy-to-let fixed rate as of Friday of last week was 4.87%, and 5-year fixed is 5.44%. So this compares to 2.9% for an average 2-year fixed rate and 3.18% for a 5-year fixed rate in December of last year. Now, Moneyfacts figures also show that the number of buy-to-let mortgage products has fallen by 359 products, right down to 862 again as of Friday. Now, between Tuesday and Wednesday, Moneyfacts said it saw its biggest fall in daily products, again reflecting just a mirror of what was happening in the residential market. And it was the biggest fall in products since it started recording the data in 2011, with product count decreasing from 507 down to 507 from 1,221. Now, I'm really keen to hear from brokers on our panel if their advice differs for landlords, and also from a lender's perspective, where you think the buy-to-let market will land. So, Graham, I'm going to come to you first.
Yeah, it's an interesting one, that one, isn't it? Because, of course, we've got the changes coming up in 2025. So I'm a little bit reluctant at the minute to recommend a long-term fix based on the fact that, to get a property energy rating of C or above by 2025 could be absolutely thousands and outweigh the fact that I've tied them in for 5 years. So for myself, I'm advising on 2 years for buy-to-lets just at this minute in time. It's a question about, do they have to reverse the fact that they've made this claim, because we're already losing landlords within an industry that's fraught with taxation costs and changes to limited companies and what have you. So there's a lot of if buts and maybes around landlords at the minute. But my advice is maybe 2 or even 3 years at the most to then see what the energy will be at in 2025.
Such a good point, that, Graham, as well. As I think you're right. Again, I know I bang on about this all the time, the value of advice, the value of the intermediary market and brokers' advice, because of course landlords are just panicking about rates, but you can see what's coming in 2025. Malcolm, you had your hand up there.
Yeah, just one small point to add. I think we've had an announcement from one of the lenders yesterday, one of the high street lenders, about the stress test as well. And now they're stressing at sort of over 7%. So this is obviously going to impact on the actual availability of mortgage products for landlords as well.
Yeah, really good point. Claire, from a lender's perspective, where do you think this is going to land?
Yeah, I think again it's another tricky one, Nicola. I mean, I think there needs to be a lot more work and education around what's coming in 2025. There's not that much out there to help, especially advisors when they're speaking to landlords about what potentially they need to be looking at. I think it's been quite interesting to see over the past few weeks as well, where there's been a bit of a change with regards to 2 and 5. 2 years seems a bit too short, 5 years seems a bit too long, so 3 seems to sit nicely in the middle, and more lenders are now coming out with 3-year products when traditionally it might not have been, an area that they sort of focused much in. So I think there's a lot of work that needs to be done around what is coming in 2025 and what does that look like for, you know, landlords. What's that going to look like for tenants as well? Because, you know, any potential increases, you know, more than likely will be passed on to tenants. So could we start to see the rents increase? But from our point of view as a lender, we're conscious of, you know, I know we've just touched on the stress rates, and we're conscious of that. So we've recently just made changes because, you know, if it keeps going up with SVR and lenders don't look at that and lenders don't make changes, we're going to price ourselves out as well. So that's something that we've recently just changed across our buy-to-let. And also making sure that, you know, we're lending in all areas of buy-to-let to make sure we've got those options for landlords as well. So it's something that we're really keen on to support.
Brilliant. Thanks, Claire. Andrew, did you want to come in on that?
Yeah, just really quickly, I was only going to say, I mean, we do most of our buy-to-let business within the expat buy-to-let side of things, and we've certainly seen, as rates have gone up, the impact on the ICR. Particularly on things like the 5-year fixed, where the 145 at pay rate calculation has certainly done us proud for quite a while. As the rates have gone up, it really has impacted on the amount of borrowing that people can do, and I think it will focus maybe some more minds around things like top slicing and other ways to try and get the loan amounts. And I think it won't affect everybody, but it definitely is going to be a challenge for some people.
So, I mean, it sounds like from there that there's room for innovation, perhaps, from lenders. Tom, would you agree?
Yeah, I think it's about sort of diversifying and thinking about different ways. Like Andrew mentioned there, top slicing is certainly one. And I think the people that probably like to be affected the most, you sort of you have a go landlords. It's the people who are looking to purchase that one property because it gives a little bit more cash in retirement, that sort of thing. But I think it's going to be quite an interesting time over the next couple of years for certainly for landlords. If I think I mentioned about the EPC changes. If I think about certainly where I live, where sunny South Yorkshire, there's a lot of property prices aren't particularly high. So, if you've got properties that are, a mid terrace that's, EPC of like an E, for example, are you going to spend, 30-40 grand bringing it up to scratch when it's maybe only worth 80,000-90,000, for example? So I think there might be a big offloading of landlord property in the future. So I think there's a lot of things to think about over the next couple of years for landlords.
Absolutely, and of course, that creates another opportunity in the market space for arguably first-time buyers, home movers, and all of that. So that'd be an interesting one to see how that develops and see where it does go. Claire,
I was just going to say, I think that it is going to be a challenging time, but it does create the opportunity for lenders to look at what we do, how we can support, what niches we can help operate in as well. So I think it is going to be challenging. I think it's going to be really interesting. But, like we've said before, we are such a resilient bunch. We've been here before and we've all come through it, and we can do it again because that's what we do as an industry. So I think, a pat on the back for everybody, whether it's a lender, whether it's a broker, whether it's a sourcing provider. I think we've got this and we can certainly come through it.
Lots of love for that one on the emojis, Claire, for sure. Definitely. Now we are just going to go now to Laura for the update from last week. So, but we are just going to stick to just criteria updates because do you know what? We're only here till 12. So if we went through the products and everything like that, we would be here quite a while. But while Laura is doing that update, a couple of things. First of all, if you want to invite anyone, the little paper plane down at the bottom is where you can invite anybody to listen to those. So if you've got somebody in your team or somebody that you think would benefit, invite them now. They can just join on. And then while we're doing that, if you want to raise your hand, I'll bring you onto the stage because when we get back in 5 minutes' time, we're going to be getting your opinions. Lots to discuss. I'm imagining it's going to light up this morning. So just raise your hand and I will bring you up onto the stage ready to have your say. Laura, over to you.
Thanks, Nicola. Morning, everybody. So as Nicola has said, I won't be going through any product range withdrawals or releases in this update because I think the list will be a lot quicker to tell you lenders who haven't made any changes. So we did have some criteria changes last week. So let's have a look and see what these were. Hodge have made some changes to their 50 plus interest only mortgage for when sale of property is chosen as the repayment vehicle. The following minimum equity values apply. So Scotland, excluding Dundee and Edinburgh, and the North East is 100,000. Northwest, Yorkshire, Humber and Wales is 120k. London is 250k, and the rest of the UK is 150k. So Hodge have temporarily withdrawn some of their product ranges, but it is still worth noting this down for when they do release their new products. Stafford Railway Building Society, there you go, that's a mouthful, has made a lot of positive changes to their criteria this week. So a few examples of these are: maximum age at the end of the mortgage term has been increased to 95. Satisfied CCJs and defaults are now accepted up to £500, which is an increase from their previous criteria of £300. Right to buy applications can now be taken on houses up to 100% of the discount purchase price. They have also reduced their packaging requirements to make it easier for you to get your case looked at by the underwriter. So please take a look at their website for full list of changes. Foundation Home Loans has introduced their new F1 tier to open up their products to a broader group of customers and to give access to products for those who may not have been able to borrow with them before. The F4 credit tier products are up to 75% loan to value, and full details can be found on their website. CM Wealth and UK Bridging Loans have now gone live on Knowledge Bank with all of their criteria for their bridging products. You can search these in either the bank or specifically in a bridging lending type search. Accord Mortgages have stopped submission of new DIPs until new business products are available. They withdrew products earlier this week in response to the current market conditions to review their policy and pricing. Once new products are available, they will email all registered brokers. Brokers can still log on to the MSO portal and will be able to progress fully submitted cases and get case updates as normal. I also wanted to just take this opportunity to talk about Knowledge Bank and how we're helping brokers during this challenging time period. So firstly, we're keeping brokers up to date. So with our criteria update email, which is usually sent out twice a week, but at the moment we are sending them out daily. These emails list all the adjustments to products and criteria of that day to help brokers keep on top of the changes. And secondly, to echo Nicola earlier, we don't have any products on our system, but we can see that both brokers and lenders are in need of help. So we are perfectly positioned in the advice process to be able to assist in these challenging times. The team have quickly made the move to add product news to the system in the form of lender banners, which are updated in real time. Now, as a broker uses the system to place their cases, they can see whether the lender they want to go with has products available or is accepting new business. And that is it for me from this week.
Fantastic. Thank you, Laura. So if anybody would like to have their say on anything we've discussed today, or speak to one of the lenders about what's happening in the market, any questions that you have even, or brokers who are with us have some points to make, I'm sure you are chomping at the bit to have your say. So please just raise your hand and I'll bring you onto the stage and we'll go from there. But until you do, I will keep on with the headlines because, as I say, we weren't short of them at all last week. One that did catch my eye, actually, so just staying, we were talking about the rental market and landlords and how this is going to affect them. And it caught my eye last week that the NRLA, so that's the National Residential Landlords Association, have written to Chancellor Kwasi Kwarteng to adopt a cost of living plan for the private rental sector. They warned that while private rents are increasing, rising costs such as energy, food and other bills will make it more difficult for tenants to meet rent payments. The NRLA also pointed out that landlords are struggling too, with recent research by estate agency Hamptons concluding that the impact of rising interest rates on mortgages raises the prospect of landlords making a loss on their properties. Now, the Landlords Association also noted that most landlords can't shoulder the cost of rising prices indefinitely. It cited official data showing that 69% of private landlords are basic rate income taxpayers. The NRLA are asking the government to adopt a plan for the sector to be financed by a reported £1.5 billion underspend in budgets at the Department for Levelling Up, Housing and Communities. Now, the plan includes reforming the benefit system to prevent rent arrears, which could also involve the unfreezing of housing benefit rates, ending the 5 weeks to wait for the first payment of universal credit, and giving universal credit claimants the ability to choose at the start of the claim to have their housing element paid direct to the landlord if they so wish. Now, this is quite a significant step. There's always been, which lenders will take rents paid directly and which how does this sit with our panel? Anybody got any thoughts on this? Because this is quite a bold move, isn't it, by the agency? Any lenders or brokers want to go first? Oh, you've all gone shy this morning. Malcolm, do you want to give us your thoughts on this, and then Andrew?
I think my immediate thought was that obviously it's great that they're highlighting this point, but whether that goes anywhere near the top of the Chancellor's in trade this morning, I don't think I don't think so. He's very busy with other things at this moment, and of course it's off the back of that fiscal statement that we've had, the chaos and the panic that we're still kind of reeling from last week.
Yeah, really, really good point. Andrew, what are your thoughts on this?
It's a tough one. Yeah, it was a big. I mean, actually, completely agree with the last comment there. I think it is. We hear a lot of suggestions, a lot of things talked about, and not that many actually sort of get beyond that stage. I think there's scope to look at what goes on around there, but I think it's not one for the immediacy. I think it's very much about the rates at the moment and what people are paying, and and very much sort of the real cost of living sort of impact. That's the more direct and more immediate, I think, need.
Yeah, I mean, it's throwing that into the mix, isn't it? I guess where you know, and how that's going to pan out over the next 12, 18 months. Graham, what are your thoughts?
It's an interesting one, that actually. NRLA you were talking about, and obviously rights to the to Parliament. My thoughts were, when I was just thinking and hearing your comments, profit comes into it actually, and we think as a landlord, is it almost wrong? You're almost feeling wrong that you're making a profit. Is it wrong to make a profit? Is it wrong to put rental up? Well, actually, it's not, because the idea is that you're in the rental market as a landlord to actually make money. So you do question, and it goes back to what you were saying about EPC as well in 2025. You've got a lot to think about as a landlord itself. Would I enter this market personally as a landlord, as a buy-to-let? Don't think it's right for me at the minute, because I'm just watching the market. And if I'm feeling that, probably everybody else is feeling the same as well. Profit's not a dirty word. Profit really is there to obviously be made. And I think you just eat it into the fact that there'll be hardly any profit by the end of it. And the strength is going more towards the tenants than it is to actually the landlord. So I'd appreciate any comments as well from anybody else.
Absolutely. And again, if anyone has anything in the audience that they want to say, if just worth saying as well, if you are in an environment where you can't put your microphone on, we can't see you, bear in mind, so you've only got your microphone, but if you're in a noisy environment and you want to have your say, DM me on LinkedIn and I'll read your comment out. Or if you're just shy, I'm sure you're not shy in our industry, but if you are, just send me a DM on LinkedIn. But if you want to raise your hand, I'll bring you up onto your stage. Anybody else from the audience, either Claire, from our panel, Claire or Tom, any thoughts on this?
No, nothing from. I think we've covered. Sorry, I think there's as Graham said. I think there's a lot to think about, and it's quite refreshing actually to hear someone say, that the average landlord isn't there to house and can't get onto the ladder. They're there to make profit. So I don't think there's any shame in it. But no, that's a really interesting point. But probably nothing more to add from myself.
No, brilliant. Okay, so moving on then. I was interested to read last week that the property group Zoopla said it expects the market to slow down, but no crash is on the way. So, which is interesting. So they said they expect a price growth slowdown, but not a housing market crash in Q4 and going into 2023 as buyers react to the rising costs of borrowing. Asking prices are already being revised downwards, it said, as sellers reprice for the season and to adjust to reflect the hit in buying power. They suggested higher mortgage rates mean buying power could be reduced as much as 28%. But if interest rates hit 5% by year end, according to Nationwide's house price index, actually, the average house price in September rose to 9.5% year on year to £272,259, which was down 10% growth in August and 11% reported in July. Monthly growth was flat in September compared to 0.7 increase in August. But what are our panel's thoughts on the housing market? Are we seeing a levelling off after the exaggerated growth that we saw pre-pandemic? Or is there a bigger cause for concern? Who's right and who's wrong here? What are you expecting? Really keen to hear from both lenders and brokers' perspectives on this one. Malcolm.
Yeah, well, this is such an easy one. When are these predictions ever right? And I think a lot of this, I mean, we've done a great job of leveling up today's panel, Nicola, because we're practically all of us up in Yorkshire, aren't we? I've noticed. And people are very quick to talk down the property market. Yes, 20% since COVID is not sustainable in long term. We all understand that. But equally, we failed to build enough houses. You know, last year's target was 300,000, 180,000 we managed. I think those of us like Graham and I that are at the coalface will still be seeing multiple offers going in on properties. So you're up against 10 people, 20 people, all making an offer. So clearly we can't continue with these rises that we've had over the last couple of years. But I think those of us that are actually doing the job will tell you that the demand is absolutely there. And yes, mortgage rates are going up, but rents will be going up as well. So as a first-time buyer, that is your stark alternative. Is, you know, as long as it's affordable, you'll find that most people want to continue to buy, and the demand is always much higher than people who perhaps are not at the coalface would realise.
Thanks, Malcolm. Graham, I'm going to come to you next, and then to Andrew, and then Claire.
Yeah, it's an interesting one, actually. Demand is still outstripping supply. So we've still got more people wanting to buy than there's actually available on the market. I'm still got first-time buyers in my diary this week. Still got people wanting to move. But interestingly enough, I do question at what percentage does it actually start changing? The higher end, I have had a few pullouts at the higher end where people are buying at 500,000 plus. They're getting a little bit edgier, but the lower end, anything from 100 grand upwards, up to that 500 mark, is still flying. So, and you do question it, you know, although interest rates are going up. I mean, I've been in finance since 1999. In 2006, before the crash, famously, interest rates were around about 6 to 7%. People were still buying houses even then. This is now, we're seeing the adjustment now, I feel, the adjustment from the lower rates into the higher rates, so are a bit more normality. You know, you couldn't have rates continuing at 0.99% fixed for 5 years. That's just not realistic. You know, people were still buying houses back when it was 7%. I was doing 100% mortgages in 2006 for that rate, would you believe? And people just didn't have as many Domino's pizzas. But they definitely got a house, and they lost weight at the same time.
It's a win-win. It's an absolute win-win.
I could do with that diet. It's called the economy diet, and I need going on it now.
But you're right, and exactly the same. I remember that when I was a broker, and especially when rates dropped, like sort of post credit crunch 2008 onwards, and saying it'll not last, and it kind of did, and everybody's got used to that, haven't they? I'm going to come to Andrew and then to Claire for your thoughts on this.
Yeah, I think some really good points there, and I think the key for a lender is how much money can a customer borrow, and it's affordability, and it's going to be the impact on things like changes in interest rates and background stress rates and ONS figures and the cost of living going up that's going to impact how much we can lend to people. And I know we've covered this in Lenders Live before, talking things like the 4.5 times income multiplier and that 15% of stuff that we can do above that. But I think the key thing for us is it affordable, and then that's about trying to make sure the customer can then find the house that they need within that price range, because ultimately, and there's lots of choices, different lenders out there, so it's not just about it's back to the absolute value and strength that a mortgage broker brings to this process in looking at the different options that are out there. But ultimately, I think whilst there might be some correction, I don't see a drop in prices, particularly, and I think it just comes down to really what people can borrow. If they can borrow it, if people need to move, they need to move. If people are moving around the country or want to upsize because they're having families, they will move. They may just have to look for slightly different property.
Or stop eating more Domino's, as Graham said. Quite right.
Fair point, yeah.
A really good point. Claire, what are your thoughts on this?
Yeah, I think Graham's spot on. I think this is going to become the new norm. I think these rates are going to become the new normal rates that we're going to sort of see moving forward. And the days of the, really low rates are probably going to disappear for quite a while. But I think from a lender's point of view as well, yes, we need to demonstrate the affordability. And the lenders that are on this panel today, because we are a bit manual, we are a little bit more bespoke when it comes to underwriting, we can assess affordability more on a case by case basis, but we can also again look at those niches where we can help a first time buyer get on the property ladder, where they may need a bit of support from a family member, whether it's affordability or deposit, to help with those increased deposits that they're having to find because the property market has shifted. I don't see property prices coming down that much. I think they may settle a little bit more, but I don't envision them coming down that much. But I think again, it just brings an opportunity there for advisors who are giving the best advice, and then the lenders to look at those niches. We want to help and support. We want to help people achieve their dreams of getting on the property ladder. So what can we do differently to help them do that?
Great point, Claire. Thank you. As always, if anyone's got anything to add from the audience, you're all a shy lot this morning, I tell you. But I'm quite sure you've got your thoughts on this. But if anyone wants to raise their hand and have their say, I will bring you up onto the stage. Moving into the last 12 minutes of the session now, and just one of the things that dominated the headlines last week that I just want to go around and get your opinion on is the Bank of England stepping in to sort of, what can they do about obviously the pound falling in rates and how that's going to work with the money markets and what that can do to stabilise the economy. But, we're looking specifically at the mortgage market. Really keen to get thoughts from both a lender's perspective and a broker's perspective. We're in a unique position today because we've actually got 3 building societies on with us and as lenders, and that's the way you're funded is very different, isn't it, to then looking at whether it's specialist lenders or the big high street banks. So what are your thoughts on this? Who'd like to take that first? Tom, do you want to jump in?
I just put my thumb up 2 seconds after you said that, so it looks like I was scared now. Thanks a lot. So our funding is probably a little different to some lenders out there, though I imagine very similar to the other lenders on the panel here. So a majority of ours will come from our savers. But I mean, in terms of the question, I think it's a really difficult one to answer. I don't think there's a clear-cut solution, or whether we should have more intervention from the Bank of England or less intervention. I think, without getting too political about it, I think what doesn't help is that it almost feels like the Bank of England have got one sort of solution and the government are offering something different. And I think they almost sort of counteract each other, which I'm not sure how helpful that is. What I would say, though, is that markets, we like stability. We like to know what's going on. We like surety and certainty. And I think that's probably what we're lacking at the moment. Obviously, I had an announcement this morning that the 45p tax rate there's been not a reversal, is a listening session's happened. So there's going to be a bit of change there. So I think whilst we've got that uncertainty in the market, it's really difficult to know what the outcome will be or how to proceed further forward. So as I say, I think for us it's about understanding that certainty really.
Yeah, thanks, Tom. And I think everybody in the market likes certainty, lenders, brokers, and of course customers as well. Andrew, you had your hand up there.
Yeah, I must admit, I actually took some. What Tom says about funding stuff is absolutely right. We are funded differently, so we're not as exposed directly to some of these things. But ultimately, I think I took great confidence actually from the fact that the Bank of England, got involved and did what it needed to do. I think the worry, obviously, is the fact they had to in the first place. Because I think without that, I don't know where the markets might have gone over the last, those, was it sort of Wednesday or was it Tuesday they stepped in? But certainly that last couple of days after that would have been very, very interesting. I think with the U-turn as well, I think that brings some stability there. And I'm hoping that is actually the warning shot to the government that actually the Bank of England had to step in, and the fact they had to step in creates jitters, which means actually they got this one wrong. And again, not wanting to be political, this is not about politics, but you can see the impact it's had on everybody over anybody in the mortgage market, be it customer, be it broker, be it lender. Wow, what an impact this week has had.
Yeah, massively. And you're right. I mean, we're not talking politics, but it's almost difficult not to, isn't it? To be fair, because these decisions are rooted in, what happened in the mini budget. Malcolm, I'm going to come to you next.
Yeah, I don't mind bringing the politics back into it. I'm not representing anyone apart from myself here, and I'm not too keen on overpraising the Bank of England here, especially another comment that they made last week, which was that they wouldn't hesitate to raise interest rates. Well, that's interesting, isn't it? Because I feel they were very hesitant during 2021 when the signs were there that the economy was recovering. But anyway, better late than never. In terms of the impact on lenders, obviously, these are smaller lenders that we've got on panel. It's fantastic to hear from them. But I think the bigger lenders perhaps could be doing a lot better in terms of educating the broker community in terms of how these things affect their pricing and why they're having to pull the products at such short notice. Because then if we as a community understand better, we're able then to communicate this to our customers in terms of why the market is so volatile right now.
Such a good point, and something we talked about doing here at Knowledge Bank actually, and I'm thinking we need to press the button on that, because it's amazing, isn't it, that the number of brokers and even people who work for lenders that don't fully understand how funds come about, how mortgage products are developed. It's a really interesting point. Graham, I'm going to come to you next.
Yeah, great. Well, I was thinking this. What impact? I don't know the impact. I think, is it more led towards pension crashes or anything such as? I don't know. The only thing I would know from a layman's perspective, when it comes to big figures such as £65 billion coming from the bank, is from a customer's perspective. What does it mean to them? What does it mean to the end consumer? And to be fair, they don't have a clue. It's down to us again to reassure them that that they will. Okay, lenders are still lending. Interestingly, in this economy, it's totally different, isn't it? Back to when we went to the crash, is that money is there. There's an absolute abundance of money to be lent out, and that's what we need to get across. It's just the fact that the products were pulled at the point. But when the media use such as words as emergency, a potential emergency rate increase, that's when it creates instability. I think the media has a lot to answer for. When you see the fact that the pound is getting stronger against the dollar now, and I've been watching that keenly against the Australian as well, nothing said about that in the media. Give us some positivity. It does seem to be all negative. So last week on Monday, it was an emergency potential increase. They put 65 billion in. That now seems to have wavered, and there was no apology for that to say, do you know what? There's not going to be an emergency increase. So, it's you're damned if you do and you're damned if you don't, really, aren't you?
Yeah, such a good point. And I say that unfortunately, the customers are just exposed to what they see on TV and radio and what they hear, and they don't have the insight that we do in the markets. So as we head into the last 5 minutes, I am just going to go around, and because I think we do sometimes do this. I think this week is really, really pertinent. Advice for brokers, advice for lenders. So, or what lenders can do to help brokers, and what brokers can do to help lenders, specifically with everything that's going on. Any advice that you'd have? Lenders, I'm going to come to you first. Advice for brokers. Obviously, they're navigating their way through product pulls, relaunches. Tom, what can brokers do to help lenders, or what advice can you give?
Two things for me. First one is speak to BDMs. Pick the phone up. Make sure you're having that communication, because invariably you'll be able to guide around where we can. But I think the most important thing probably is to get your apps in as soon as you can. We can't hold products forever. As we touched on earlier, where possible, we will honour rates, but we can't do it forever. So I think once you've had that dip agreed, get that application as soon as you can and get that rate reserved. We don't know what's around the corner, but the odds are, things are going to keep, there might be a little bit of time before things stabilise. So, odds are rates are going to keep jumping and changing. So, get that application in as soon as you can, get that rate reserved, because, it saves you going back to your client with an increased rate.
Brilliant. Thanks, Tom. So last 4 minutes, I'm going to come to Claire, then Andrew, and then I'm going to ask Graham and Malcolm to step in of what lenders can do to help brokers. So Claire.
Yeah, so mine's a bit similar to Tom's, really. So it's speak to us, whether it be your key account manager, whether it be, the DIP team, whether it be the underwriters, speak to us, have those conversations with us about what challenges you're finding with regards to potential cases, and let's see what we can do to try and help. And the second is, yes, secure your rate as quick as possible, but also try and make sure that you package it as well as possible as well, because the quicker we can get that through the system, so not just the DIP, but even the application, the quicker we can get it through the system for you and get that offer out, the more certainty we have of being able to help your applicant. So that would be my sort of 2 words to help support, really.
Fab, thanks, Claire. And then Andrew.
Really 2 things. One is the common theme, communication. Talk to the lender, just make sure everything is still live and up to date. But the other thing is check, the up to date sourcing systems, check the knowledge, things like Knowledge Bank and what's happening with all the products. Make sure you're really au fait with what's there, because I think you can have a conversation 1 minute and the rate's gone, and the customer needs to have a different conversation with them. So yeah, just stay very, very aware of all the changes by checking things like Knowledge Bank.
Fantastic. Thank you, Andrew. So Graham, I'm going to come to you first, and then Malcolm, you have the last word. What can lenders do to help brokers through this time?
Yeah, I think it's exactly that, actually. Using Knowledge Bank, for instance, that's the big one. Just ensuring that they're keeping their side of Knowledge Bank updated. Sometimes you'll find that we find something out to do with criteria that they've made a change. We then report it on Knowledge Bank to say that it's been updated. So we're actually obviously nudging you, where it should be the lenders nudging yourselves to say, look, they've made the criteria change. So for lenders to access Knowledge Bank to make sure criteria is updated is a must. To work with us on products and to keep full communication with the broker as well. And yeah, just continue with the support. I think we're all in it together, aren't we? Whether we're lenders, we're brokers, surveyors, solicitors, whatever it would be, just all need to work together.
Absolutely. Good, really, really great points. Thanks, Graham. And Malcolm.
And sorry to end this on a bit of a controversial note there, really, especially when the lenders probably haven't got time to come back on this. But a couple of commentators there have mentioned about reserving products as quickly as possible, getting the cases in. Well, I'm sorry, as a directly authorised firm, I want to be making sure I've got a robust file. I want to be checking those bank statements, checking those pay slips. I don't want to expose UK Moneyman to any unnecessary risk by rushing cases in that are half-baked. I'm not prepared to accept that as a business owner, and we do need proper notice when products are being withdrawn. I think lenders could work on systems where there's a way that we can reserve the products in advance. Then you're controlling how much that tranche of money is being lent out at, and the profit margins will be there. So yeah, I just don't think rushing cases into lenders is the answer.
Such a good point to finish on, and it really is, isn't it? Because of course you've got your compliance to make sure everything's right, and everyone would agree with that. And I guess from a lender's perspective as well, they're hamstrung in the same respect, but that lines of communication and finding a way for you to reserve products, but then really doing your checks to make sure that the quality of the case that's going in is imperative. Really, really good point, Malcolm, to finish on. So we are almost straight up 12 o'clock. Thank you to everybody. And massive thank you to Graham, Andrew, Tom, Claire and Malcolm, and of course Laura as well for the criteria update. Join us again next week when we will have a brand new panel of speakers. Obviously, in the meantime, you can keep up to date on our system, as we've mentioned this morning, and get those insights that you need from both a lender's perspective and a broker's perspective as well. Massive thank you. Let's have a show of a clapping emoji. Oh, look at you all there fluttering your emojis for our panel. Thank you. Thank you very much. It's much appreciated. And we'll have a great week. Hang in there, and we will see you next Monday at 11 o'clock with another episode of Lenders Live. Thanks, everyone. Have a great week.